There's a single 3-digit number that can decide whether you get a loan, the interest rate you pay, the apartment you can rent, and sometimes even the job you can get. It's your credit score, and most Americans were never taught how it works. According to the Consumer Financial Protection Bureau, it runs from 300 at the bottom to 850 at the top. The higher it is, the cheaper it is to borrow. The lower it is, the more everything in your life quietly costs. Today we'll pull that number apart, what it's built from, who decides it, and the simple do's and don'ts that move it. No jargon, no sales pitch, just the facts you need and what to do with them. This is your credit score. Let's break it down. I'm Don Blake, and this is USAFinance, the channel that gives the everyday working American the real facts about money, credit, and the banks you deal with every day. No hype, no get-rich-quick nonsense, nothing for sale. Just sourced, plain English answers to the money questions that actually affect your life. Your credit score is where we start, because almost every big financial decision runs through it. Your car, your home, your credit cards, even your insurance. Everything on screen comes from government and industry sources: the Consumer Financial Protection Bureau, the Federal Reserve, the FTC, and the companies that build the scores. If this helps, do me one favor and subscribe. It's free, and it's how this channel keeps going. So let's start with the basics. What is a credit score really? It's a number that predicts one thing: how likely you are to pay back money you borrow on time. It's your track record as a borrower, boiled down to a single figure. Lenders use it because they can't know you personally. Instead, a math model turns your credit history into a score they can compare in seconds. The Consumer Financial Protection Bureau puts it simply: a credit score is a prediction of your credit behavior based on the information in your credit reports. A higher score tells a lender you're a safe bet. A lower one tells them you're a risk, and they price that risk by charging you more or turning you down. This one number is, in effect, your financial reputation. Now, the scale itself, because the number only means something once you know where you stand. The two most widely used scores, the FICO score and the Vantage score, both run from 300 to 850, and lenders sort that range into bands. Below 580 is usually poor. From 580 to 669 is fair. From 670 to 739 is good. From 740 to 799 is very good. And 800 and up is exceptional. Here's the key: you don't need a perfect 850. Almost nobody has one, and you don't need one. Once you cross into very good, around 740, you qualify for the best rates most lenders offer. So the goal isn't perfection, it's getting comfortably above that good line and keeping it there. Why does this number matter so much? Because it follows you everywhere, often without you realizing it. A lender uses it to decide whether to approve your mortgage, car loan, or credit card, and what rate to charge. A landlord may pull a version of it before renting to you. Many insurers use a related score to help set your premiums. Some employers check a modified credit report when hiring, especially for jobs that handle money. Utility and phone companies may use it to decide whether you owe a deposit. So your credit score isn't just about loans. It quietly shapes the price you pay for ordinary life. And most of the time, you never see it happening. That's exactly why understanding it matters. You can't manage a number you don't understand. Let's make the cost concrete, because here's where the dollars get real. Picture two people borrowing the same $300,000 30-year mortgage. One has an excellent score and gets a low rate. The other has a fair score and gets a higher one. Even a difference of 1.5 percentage points in the rate can add up to tens of thousands of dollars more over the life of that loan. Sometimes more than $90,000 in extra interest. That's not a fee you see on a bill. It's baked silently into every monthly payment for 30 years. The Consumer Financial Protection Bureau says it plainly: a better score can save you a substantial amount on interest. The same holds on car loans and credit cards. Your score isn't a grade for its own sake. It's a price tag on every dollar you'll ever borrow. So, how is this number actually calculated? The exact formulas are secret, but FICO publishes the 5 ingredients and roughly how much each one counts. The biggest, about 35%, is payment history, whether you pay on time. Next, about 30% is how much you owe, especially against your credit limits. About 15% is the length of your credit history. About 10% is new credit, how many accounts you've opened recently. And the last 10% is your credit mix, the variety of credit you handle. Look at those numbers and the strategy writes itself. Payment history and how much you owe make up about 65% of your whole score. Master those two, and you've handled almost 2/3 of everything that matters. Let's take them one at a time. Factor number 1, and the most important, payment history, about 35% of your score. It comes down to one habit: paying on time. Every loan and card reports to the bureaus each month, marking you on time or late. A payment 30 days or more past due can be reported, and once it is, it can sit on your report for up to 7 years under the Fair Credit Reporting Act. One late payment can drop a good score sharply, so here's the most important do in this whole video. Pay at least the minimum on every account every month on time. The simplest way never to miss is to automate it. Set up auto pay for at least the minimum on every card and loan. That one step protects the biggest piece of your score automatically. If you're already behind, get current and stay current. The damage fades, but only once the on-time streak begins. Factor number 2, how much you owe, about 30%. The piece that matters most has a name worth knowing, your credit utilization ratio. Utilization is how much of your available credit you're using. If your cards total a $10,000 limit and you carry $3,000 in balances, your utilization is 30%. The common guidance from the CFPB and credit experts alike is to keep that ratio low, generally under 30%, and lower is better. People with the highest scores often use less than 10%, so the do, pay balances down and don't let them creep toward your limit. A smart trick, pay before your statement closes, not just before it's due, so a lower balance gets reported. And the don't, maxing out a card, even if you pay it off later, can hurt your score the moment it's reported. Keep room between what you owe and your limit. Factor number 3, the length of your credit history, about 15%. This one rewards patience, and it leads to a do and don't most people get wrong. Lenders like a long track record. The score looks at the age of your oldest account, the average age of all of them, and how recently you've used them. So the don't close your oldest credit card, especially if it has no annual fee. People close old cards to tidy up, but that can shorten your history and erase available credit, hitting your score 2 ways at once. The do is simple. Keep your oldest no-fee card open and active. Put a small recurring charge on it and set it to auto pay. That keeps the account alive and your history long. Time is doing free work for your score. Don't undo it. Factors 4 and 5 round out the picture. New credit and credit mix, about 10% each. New credit looks at how many accounts you've opened recently. When you formally apply, the lender does a hard inquiry. It can ding your score a few points and stays on your report about 2 years. So the don't apply for a bunch of cards or loans in a short window. A flurry of applications signals risk. Space them out. One reassurance, checking your own score does not hurt it. That's a soft inquiry, free to do as often as you like. Credit mix is just the variety you manage. Cards, an auto loan, a mortgage. Don't chase variety or take on debt you don't need. Handle what you have well, and this small piece takes care of itself. So where does all this information live? With 3 big companies you should know by name, Equifax, Experian, and TransUnion, the 3 nationwide credit bureaus. Each one collects your credit history, accounts, balances, and payment records into a file called your credit report. Your score is calculated from what's in those reports. Here's a fact that surprises people. The 3 don't always hold identical information. A lender might report to one bureau but not another, so your score can differ depending on which one a lender checks. That's also why you can't look at just one and assume it's the whole story. These companies are regulated by the Consumer Financial Protection Bureau, and that regulation gives you some powerful free rights. Here's one of the most valuable facts in this whole video, and it costs you nothing. By federal law, you're entitled to free copies of your credit reports from all 3 bureaus. The one official, government-authorized site is annualcreditreport.com, and the bureaus now provide these reports free every week. So go to annualcreditreport.com, not a lookalike site, not an app charging a fee, and check your reports regularly. It's free, and checking your own report never hurts your score. When you read it, look for 2 things: accounts you don't recognize, which can signal fraud or identity theft, and mistakes. A payment marked late that you made on time, or a wrong balance. Reading your own report is the best free habit in personal finance. It's your file. Know what's in it. Why check so carefully? Because credit reports get things wrong more often than you'd think, and the errors are your problem until you fix them. In a landmark study, the Federal Trade Commission found about 1 in 5 consumers had an error on at least one credit report. An error can be a wrongly reported late payment, an account that isn't yours, or a paid debt still showing as owed. Any of those can drag your score down for no reason, but the law is on your side. Under the Fair Credit Reporting Act, you can dispute errors for free, and the Bureau generally must investigate, usually within 30 days. So if you find a mistake, dispute it in writing with the Bureau and the company that reported it, and keep copies. The CFPB and FTC publish free, step-by-step instructions. Fixing an error is one of the fastest, legitimate ways to raise a score held down by something that was never true. Let's zoom out, because your score doesn't exist in a vacuum. It's a snapshot of a much bigger picture, what Americans owe. According to the Federal Reserve Bank of New York, total household debt in the United States now stands at roughly $18 trillion. Mortgages, auto loans, student loans, and credit cards. Credit card balances alone have climbed past $1 trillion, a record high. And here's what matters for you. Credit card debt is among the most expensive money you can borrow. The New York Fed also tracks how many borrowers fall behind, and in recent years, delinquencies have been rising, especially on credit cards and auto loans. None of that means you're doing anything wrong. It means the system runs on borrowing, and people who understand the rules pay far less to use it than those who don't. Now the most expensive trap in everyday credit, carrying a balance on a credit card. According to the Federal Reserve's data on consumer credit, the average interest rate on cards that carry a balance has run above 21%, one of the highest rates ordinary Americans regularly pay on anything. Here's what that means. Carry a $5,000 balance at around 22%, making only minimum payments, and you can pay thousands in interest and spend years paying it off. For purchases you've long forgotten. So the single most powerful money move most people can make is this: pay your credit card in full every month if you possibly can. Used that way, a card is a free, convenient tool that even builds your score. The don't treat a credit card as extra income. The moment you carry a balance, that 21+% starts working against you every day. Let's pull the winning habits together. If you do nothing else, do these. 1. Pay every bill on time. Automate the minimum on every account so you never miss. That protects the biggest 35% of your score. 2. Keep your card balances low, under 30% of your limits, lower if you can, pay in full when possible. 3. Keep your oldest accounts open and check your free reports at annualcreditreport.com. 4. Be patient. Good credit is built with boring, consistent habits over months and years, not tricks. There's no legitimate overnight fix, and anyone promising one is usually after your money. Do these 4 things and the score takes care of itself. Now the other side, the don'ts. These are the avoidable mistakes that quietly wreck good credit. Don't miss payments. A single payment 30 or more days late can do real damage and linger for years. Don't max out your cards, even if you plan to pay them off. High balances hurt the moment they're reported. Don't open a pile of new accounts at once, and don't close your oldest card. And a big one, don't pay anyone who promises to magically erase bad credit for a fee. The Federal Trade Commission warns that no one can legally remove accurate negative information, and what a credit repair company charges for, you can do yourself for free. You don't have to be perfect. You just have to stop doing the things that dig the hole. What if you're starting from nothing or rebuilding after a rough stretch? You're not stuck. There are legitimate ways to build credit from scratch. First, a secured credit card. You put down a deposit that becomes your limit, use the card for small purchases, and pay it off each month. It reports to the bureaus like any card and builds positive history. Second, becoming an authorized user. A family member with good credit adds you to their card, and their on-time history can help your file. You don't even have to use it. Third, credit builder loans, offered by many credit unions and community banks, are designed to establish a track record. And remember, the one ingredient no product replaces: time plus on-time payments. According to the CFPB, it generally takes about 6 months of activity just to generate your first score. Everyone starts somewhere. The path up is well marked. So let's bring it home. What is a credit score, and what should you do about it? It's a single number, 300 to 850, that predicts how reliably you repay what you borrow, and it sets the price you pay for credit across your whole life. It's built mostly from 2 things you control: paying on time and not owing too much against your limits. Together, about 65% of the score. You have free, federally guaranteed rights to see your reports at annualcreditreport.com and to dispute errors under the law. Use them. And the whole game comes down to a few boring, powerful habits. Pay on time, keep balances low, keep old accounts open, and be patient. Do that, and good credit stops being a mystery and becomes something you simply own. Let's lock it in with the numbers that matter most. Your score runs 300 to 850, and roughly 740 and up gets the best rates. Payment history is about 35%. How much you owe is about 30%. Keep utilization under 30%. 3 bureaus, Equifax, Experian, and TransUnion, and your reports are free every week at annualcreditreport.com. About 1 in 5 reports has an error, so check yours and dispute mistakes for free. The average credit card charges over 21% interest, so pay in full when you can, and a negative mark can stay on your report up to 7 years, which is why on-time payments matter so much. Those are the facts. The habits are simple. The hard part is just doing them month after month. Here's the bottom line. Your credit score isn't luck, and it isn't a mystery handed down by some faceless system. It's the predictable result of a few habits repeated over time, and now you know exactly what they are. At USAFinance, that's the mission. Take the money decisions every working American faces and lay out the real, sourced facts so you can make your own call with your eyes open. If this made your credit clearer, please subscribe. It keeps this channel going and helps us reach the next person who was never taught any of this. Next time, we'll dig into the loan itself, how interest really works, and how to borrow without getting buried. I'm Don Blake, know your numbers, and we'll see you next time.